Today, the RBA's Australian exceptionalism theory. Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and prop news with a distinctively Australian flavour. So, what if Australia is not different when it comes to monetary policy? What damage will be wrought if in fact the RBA settings are wrong? Well, earlier this week, in the minutes of their last meeting, the Federal Reserve in the US confirmed that rates would go somewhat higher than previously expected, but that a slowing in the pace of increases would likely soon be appropriate. The Fed's median September meeting dot plot suggests a terminal policy rate of around 4.6%, but a new dot plot is expected at the conclusion of the next FOMC meeting on the 14th of December, and one that will move closer to a 5% ceiling, and that will mirror current market pricing. And also this week, the Reserve Bank of New Zealand raised the official cash rate there by another 75 basis points to 4.25%, while its Monetary Policy Committee projected a rate of around 5.5% by September 2023, up from its previous forecast of 4.1%. In announcing the move, the RBNZ noted that the committee agreed that the OCR needs to reach a higher level and sooner than previously indicated to ensure inflation returns to within its target range over the medium term. Core consumer price inflation is too high, employment is beyond its maximum sustainable level, and near-term inflation expectations have risen. New Zealand's current inflation rate is, on a headline basis, at least 7.2%, while on a trimmed mean basis is at 6.4%. compared with 7.3% and 6.1% in Australia. So how different are we? But despite all of this, the Reserve Bank of Australia is not expected to follow the Reserve Bank of New Zealand's path. Instead, it's predicted to stick to its Australian exceptionalism belief, a belief which GSFM's investment strategist Stephen Miller believes could do more harm than good. In his most recent update, Mr. Miller says this Australian exceptionalism theory, which is based on the notion that Australia's wage and inflation circumstances are, quote, different to elsewhere in the developed world, is profoundly lacking evidence. Certainly, he said, any difference was not evident in either the September quarter CPI or wage price index figures. Worryingly, it was a predilection towards Australia's exceptionalism, which was responsible for the egregious policy missteps from the RBA from 2021 and into 2022. The RBA has defended its comparative caution by warning against scorching the earth to get inflation down, implying a more aggressive approach involves outsized costs in terms of activity and employment, Mr. Miller said, but drawing on the 70s experience and in an echo of Chairman Powell's comments at his November press conference, an alternative construct is that the scorched earth more likely comes from central banks exhibiting some prevarication in assuming a frontline and aggressive role in containing inflation, and then having to slam the brakes on aggressively later in the piece. Now, Mr. Miller did, however, concede that the RBA might not be on a wrong track. Time will tell, he said, but domestic price indicators continue to exhibit considerable momentum. Noting that while the RBA's communication may be more nuanced and on the surface at least gives the RBA optionality when it comes to policy, Mr. Miller said he fears that it was overly reluctant to aggressively walk the walk on inflation. The upside risks of the RBA inflation forecast issued last week are clear, as are the implications for monetary policy, Mr. Miller said. That underscores the key risk with the RBA approach, that it admits the possibility of the emergence of the sort of inflation inertia that was last experienced on a global scale in the late 1970s and early 1980s. As the RBA governor has noted, the path to returning inflation to the 2 to 3% target and keeping the economy on even keel is a narrow one. I suspect that, unlike the Fed, the RBA should be possessed of greater anxiety than a few months ago. I think there are some very important points in this particular discussion, and I've continued to believe that the RBA is being too loose and too weak, but we've seen that, of course, for the last few years. I'm afraid that monetary policy in Australia is not fit for purpose. We will end up with high levels of inflation and probably higher interest rates later, but of course the pain is significant. And unfortunately, looking around the world, it seems to me that other central banks, for example New Zealand, probably has a better grip. Well, we'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer.